Hello, everyone. Hello, and welcome. Thank you very much for joining me. My name is Adam Harris. I'm a Chief Market Analyst, and I represent Trade with Precision, and I will be your speaker slash analyst slash trader for today's session. So today's session is part of the Trading Fundamentals series, and we are specifically focusing on 12 critical techniques for new traders, tying it all together. So I'm looking forward to taking you through that. If we do have time left over it, then I'm going to do a quick run through of the live markets and have a look, for example, at what's going on with the global indices, and potentially see if we're over the end of the correction that we've been waiting for a while, and if we're going to start a new leg up, if the bull market is going to resume from where we are. So the first thing that I need to do is give you an opportunity to read the risk disclaimer and digest that. So while you do that, I'll give you some background behind myself. I am based outside of London in the United Kingdom. I trade for a living, so I manage my own private capital as well as some family members and friends. I am both a day trader, so if I have a very open morning, I will participate by usually day trading currencies on the 5 minutes or 15-minute time frames. Alternatively, I'll be looking at the daily charts across stocks and currencies, looking for setups there. And then finally, also I manage stocks portfolios. So I'm predominantly a technical trader. What does that mean? It means that I look at the charts. My decisions to engage in the markets are based purely on what the charts are telling me. And I will always choose what I see happening in the charts over what I hear in the media, because the media is very often wrong. And that's pretty much it for me. So if you have any questions, by the way, I'd love for this to be interactive. Please just type them into the questions box and I'll just answer them as we go. So please feel free to interact with me. All right, so this is part 4 in a 4-part Trading Fundamentals series. And this is kind of specifically, we're going to be focusing on trading strategy and putting it all together. We need to talk about multiple time frame analysis, which is a core skill, a core concept that every trader needs to understand. And then of course we could talk about placing your first trade using a risk-free demo account. So let's go into that in a little bit more detail. So first of all, multiple timeframes. We need to talk about how to sort of discover how we align different timeframes and deciding which ones to use. These can reveal strong trends and potential reversal points. And then, of course, as traders, we need to master the art of timing our trades by combining shorter term and longer term perspectives, okay, for precision entry and exit points. And actually, a great example of that would be, and pertinent to what the current market conditions are like, is to have a look at the global indices, the S&P 500 or the Dow 30, for example. We can have a look at that. So we need to then understand how multiple timeframe analysis can enhance risk assessment and management, explore how analyzing multiple timeframes can refine our trading strategies for more consistent success. So remember that trading and investing isn't gambling. It's a repeatable, high probability action that we take, all right? The probability, it's not guaranteed, but it's very highly probable that we will make money on a particular move. But in order to do that, we need to make sure we take some profits, and we also need to make sure that we manage our risk appropriately and make sure that we exit bad situations. That's really important. Then we'll talk about placing your first trade, which is a walkthrough of placing your first trade, including how to place entry levels, stop loss, target levels in your risk-free demo account. Really, the point of a demo account, or at least the way in which you want to get the most out of a demo account, is you actually want to have a strategy. So if you're a brand new trader, you want to be picking a strategy that you're going to now apply in real market conditions. So in other words, the demo account has the same data as a real account, but what it doesn't have is, is the psychological pressure of dealing with real money. And so what you want to get out of it is testing your strategy, learning how to navigate the platform, how to calculate your risk, your position sizing, how to execute your trade. So in other words, the technical aspects of navigating the platform, as well as the application and identification of high probability trading patterns and setups, and how to take care of those. You also potentially want to take 10 trades so that you can get used to the whole process. That's really important. You want to, it's a process. And one of the first things that we have to get out of the way when we're, that every trader has to eventually move beyond in their journey, is placing trades. That's a process, right? Calculating our risk, identifying the setups, qualifying the setups, putting our entry order in and our stop loss order and our take profit orders, and having, well, thousands of those types of trades under our belt to build up experience, because that's the only way you can get experience, guys and girls, is to take trades. And that actually helps us. It sounds really odd, it's a bit counterintuitive, but the fastest way to go from being completely inexperienced to becoming a seasoned trader is obviously to take trades. But one of the ways in which we want to do that, it seems counterintuitive, as I said, is often we're just keen to jump straight ahead and start placing trades on a live account. And we don't really pick a strategy, and we don't really learn to use the platform correctly. And so we end up making a lot more mistakes, which actually cost us, it wastes our time, and we end up having to go back to the beginning again to start the process over. So ironically, a bit of patience to start slowly will get us where we want to get to a lot faster. All right. Multiple time frame analysis. So give me a second here. Sorry, 1 second here. All right, so analyzing assets over multiple timeframes is essential because it helps you determine if support and resistance differ across different charts. Absolutely, that is important. One of the ways, let me just do something here as well. I'm going to move this down. I want to have a look at something. So if we go across to the chart, so let's go ahead and have a look at the chart. And what I'm going to do, I'm going to use gold as this one because it's a particularly good way to do this. I'm just going to hide that. We don't need that. And I'm going to get rid of this. So part of the reason that I'm showing this without color is because I want to illustrate a point here. I want to show you that before charts even existed, before candlesticks existed, before charts existed, it was always about price. So if we go back and have a look at gold over the decades, we can see here currently on with this amount of data, we can go back to sort of 2001. So we can go back 24 years, give or take. And we can see kind of what the price of gold has been over time. And you can see on the right-hand side, you get the numbers. That's kind of what the price of gold has been. It's really interesting to see that only 24 years ago, gold was sitting at $250 an ounce, and now it is 10 times that. And when you think about it, in the prior 1,000 years, or at least several hundred years of trading gold prior to that, all of its behavior was below that $250. Okay, so, but price is really very important here, that we understand that price is significant. So before charts existed, traders and investors were looking at price. They were looking at the number. And so when we identify which prices are historically significant to this particular instrument, we can visually see them. So if we identify an area where price has continually or consistently encountered resistance, that's when it's bumping its head up against it, or potentially has discovered maybe some really nice levels of support, we often find that there is a key price attached to that. So in this case, it would be 1350. It's a little bit of a round number there. This one would be 1550. And also we can go another way. We can start to put in 2000. So let's just go here to a nice round number of 2000. So we'll just kind of put a line in there. We'll go to 1800. We'll just kind of put a line in here, and we'll see if the market responds to that. And so very interesting with gold, we can see that there often is a reaction very close to a round number. So humans are creatures of habit. Okay, so in the same way, there's very limited things you can do in the markets. You can buy, sell, or do nothing. That's it. And so it really kind of reduces down all of the craziness, all the behavior, all the planning, and all the different individuals and all the ideas always ultimately bottleneck and then come out as either a buy, sell, or do nothing. And so ironically, is that patterns tend to repeat themselves, and behavioral patterns tend to start to come out of crowd behavior. This is something really interesting about people, is that the more of us you put together, the more we tend to start to behave most of the time in sync. So it's kind of like, there was a horror story that I heard. I mean, I know it's funny, but it's not funny, We have two little sausage dogs. So my fiance and I have two little sausage dogs. They're tiny, they're harmless in almost every way. And we remember the story of this lady that was walking. We actually saw her the day. She was walking like 5 dogs. Now in the UK, you have to, you're only allowed to walk so many dogs at a time. And she was walking them and she had 1 sausage dog. And she had all these really big dogs as well. Anyway, the horror story part of it is we heard later on that she got attacked by the dogs. Something happened one day and all of them kind of attacked her. And one of the worst ones apparently was the sausage dog, the little Dachshund. And it was very out of the ordinary. It was very unusual behavior for the sausage dog. But the point was, because they were all in a pack, their behavior changed. So in other words, they did things as a group that they would never do as an individual. And it's the same with humans. Humans will do things as a group that they wouldn't do as an individual. Okay. So I want you to take everything here. I just kind of want to talk to you about identifying support and resistance levels. I want to talk to you a little bit about price. But the next thing that I want you to take away from this as well is that when we are using multiple time frame analysis, what we're really doing is getting perspective. This is what I want you to remember. What we're really getting is perspective. What is actually going on? So for example, if I go down to the, what I'm going to do here is just clean up the charts. Very quickly, we're going to talk about different market conditions. So I'm just going to use yellow over here. So basically, there are only 3 types of market conditions you can have. A market is trending higher. That means that it is making higher highs and higher lows. Or it is trending lower, which means it's making lower highs and lower lows, or it's not going anywhere in particular. So it's mixing up its highs and lows. It's just all over the place. Those are the only 3 types of market conditions that you can get. Sorry. So that's it. There is nothing else, which again is there are only actions we can take, which is buy, sell, or do nothing. So the reason I want to show you this is that we always want to get a sense of what is the picture, what is the bigger picture doing? Which way are the markets moving at a higher time frame? So if you can imagine that you're lost in the woods, you've gone for a hike in the woods, you're lost, but you happen to have a drone with you. So you set your drone off, you're looking through your viewfinder, which is either your goggles or your phone. And actually as the drone goes higher, you can start to see yourself there, and you pull up as you go higher and higher, you see the bit of the forest pulled away, then maybe there's a river that you can't see that's kind of a little bit further away. And as you go further up, then you see maybe there's a small town that you could potentially walk to, but maybe it's a couple of miles away. Then maybe even as you go even higher up, you see the coast and there's another town, or there's the sea is nearby. So that's obviously if you're hiking in a forest near the coast. So my point is this, is that you tend to get a sense of where you are in relation to your surroundings and where you need to go next. And that's, so as you go up the time frames, as you go from the 5-minute to the 1 hour to the 4 hour to the daily to the weekly to the monthly, you get perspective. And that's why it's so important for people to do that, so that they can gain perspective. And this is one of the things that trips up most untrained individuals. So I'm saying here that if you are trained, your performance will be better than if you are untrained. Okay, so it's kind of a term we have for people who think they know what's going on, but they've never had any trainings. We often call them an armchair investor or an armchair trader. Okay, so here we go. We're going to go down the time frame. So I'm going to go straight to the 5 minutes. Okay, so kind of what's happening on the 5 minutes? Well, if I look at the most recent moves, we're actually got a little bit of a downtrend here. We're producing lower highs and lower lows. Then we can see there's a little bit of a support level here, and then actually you see there's actually a range. There's a resistance level at the top and a support level at the bottom, and we've been working our way down from the top of the range to the bottom of the range. Okay, so all right, so we see price going down on the 5 minutes. So let's go up a little bit. Let's go up to the 1 hour. So what's happening on the 1 hour? Well, on the 1 hour, it's a bit different in the sense that here we're going sideways. So here we've got a range. We've come up here, touched the top, then the bottom, then the top, then the bottom, then the top, and now we're at the bottom again. So technically speaking, there's no clear direction. It looks like this. We've got no clear direction here, no clear direction here. It's very messy. Whereas here we had a bit of a downtrend, but then we went into an uptrend, and now we're going sideways. So in other words, the story has changed. Now let's go up to the daily. So what's going on in the daily? Oh, well, that's interesting because on the daily, we're going up. So we've gone up, higher lows, and currently we're in a pullback within an uptrend. In order for this to be a downtrend, we'd have to produce a lower high and a lower low. We're not there yet. And actually, the way that you have to do it, this is the way you have to do it if you want to be successful, is you have to treat the market as innocent until proven guilty. In other words, you have to assume that this uptrend is going to stay an uptrend until you get a lower high and a lower low. So this, in other words, until you see evidence that it's changing direction, which we don't have yet, you have to treat this uptrend as intact. And when you're a newer trader, you see this as, oh, well, it's going down now, so therefore it's going to keep going down. And that's, again, lack of experience, lack of training. All right, here's again where we had no direction. So during this period, there was no direction. Here we had a gentle downtrend, and then we went into an uptrend. So you can see the market is constantly going from up to down to sideways. So let's go back to the slide, and then I'm going to come back and I'm going to do some real market analysis with you and illustrate how important it is to look at the higher time frames. So, for example, an asset might showcase support on the daily chart near $100, but resistance on the weekly chart could be near 102. So part of this is illustrating that sometimes we see levels that we might think are, let's do this, let's turn off my webcams. We should be fine, How's the connection, guys? Is it all right? Can you hear what I'm saying? I just want to check something here. Just going to check that there's a particular application that comes with Windows called the Killer. It's called the Killer app, and it's absolutely terrible. It just destroys your internet connection, and it's designed for gamers. I'm not a gamer, but it's built into Windows. Okay, so here's the thing, is that as a trader, you might think that you're looking at a significant level here because you've got, well, support resistance there. But I'm only on the daily, and it might turn out that those particular levels, if I go further up enough, they might not be that significant. So if I go up to the monthly, for example, here's where you can really see which are the most significant levels. So we've got a little bit of support and resistance there. We've definitely got some support over here, for example, which is also resistance. We've definitely got some resistance over here. So it's a constant amount of work to identify which levels are clearly important. Here's a touch, there's a touch, there's a touch, there's multiple touches there. So we know that is a significant level. I know that is. And again, because we could kind of see the market is probably stalling a bit, this is probably going to turn out to be, it's early days, excuse me, and that's probably going to turn out to be a significant level. So my point is that by going up the higher time frames, we can definitely identify levels that are very significant, and we should tend to just be aware of them. We don't have to. I mean, in this particular case, I don't need to know these ones down here for now. The rule of thumb, if I was your trading mentor, I would say to you, you just really want to know 2 or 3 levels below where price is currently and 2 or 3 levels above if you have them. Now, this is unique, relatively unique or rare, because gold is in uncharted territory. So there is no history above this. Whereas that isn't the case, for example, with euro, dollar, or even with silver at the moment. Silver's got some history behind it. So if you go look at silver, you can see that silver has historic prices over here. So we kind of know where we are. We can also see that there's some levels of support over here, support and resistance in this area. And again, we can sort of see there's another bit of support over here. So it's easier for us to identify where those are, and that's on the weekly. When we go to the daily, it's also going to count quite a bit. So we have a bit of that. So you want to be aware, at least of where the key monthly, weekly, maybe daily levels are. That's probably enough. Alternatively, if you're a day trader and you're working on the much lower time frames, 5 minutes or 15 minutes, then probably, because the market's not going to move that much during the day, you probably want to focus on, it's nice to know if you're approaching a major monthly level, if price is heading towards that. If you're close to it, it's nice to know that. but you definitely want to be aware of where your 4-hour levels are. So for example, this is what's known as market structure. There's some market structure. So instead of using support resistance or the term support resistance, I'm using the term market structure. So here's my previous low. You can see there's also definitely a little bit of resistance where we are now, a resistance support in this area. So what I've done is I'm only applying it here. I know where the bigger levels are up there, but I'm only applying this locally to the most recent highs over here and the most recent lows over here. And that's much more sensible, because this is where it gets kind of interesting. You have to be able to keep two ideas in your head at the same time. For example, Buffett and all the well-known, very successful investors will always say to you that you ignore the day-to-day noise, because in the longer term, the fundamentals will always play out, meaning that in the longer term, the noise won't really matter, the trends will show up over a long enough period of time. And day traders take advantage of that exact idea. They believe that there are opportunities that occur only within the day that you can take advantage of, and you don't have to worry about where the market is going to be 6 months from now. It doesn't matter where gold is going to be 6 months from now. If it's going to be going down, I'll be selling. If it's not going to be moving, I won't trade it. And if it's going up, I'll be buying. So traders' philosophy is the other side of the same coin. They operate during the day with setups that are temporary setups. So the market, for example, any market trend might look bearish just for today and tomorrow, and then it goes back to being bullish. Maybe the longer term fundamentals are bullish, but even while the longer term fundamentals are bullish, during smaller short term periods, there could be bearish setups. And those bearish setups could last 2-3 days at a time, and day traders are trading every day of the week, most of the time. So if it's looking bearish, they'll be looking for sells. The next day, if it's looking bullish, they'll be looking for buys. All right. So if you're an investor, you can't really get upset about the individual days. You can't do that, because you'll go mad. You'll go, well, Tesla's been tanking, and I don't understand, because the earnings thing that happened last night was the quarterly results were terrible, but it's going up. I don't understand that. And actually, that's because you're looking at short-term fluctuations. So as an investor, you're not worried about that. As a trader, that type of behavior makes complete sense to you. Complete sense to you, because the market was overextended to the downside and people took profit. And they took profit, which meant the market boost came up a bit, but it hasn't changed the longer term fundamentals. So it's quite interesting. So traders cope with shorter term moves that make complete sense within the market to themselves, but on the higher time frames, they're not necessarily significant. Okay, so it takes a bit of practice, and I don't want you to get thrown by it. I just wanted you to get a sense of it. So for example, an asset might showcase support on the daily chart near $100, but resistance on the weekly chart, which could be near 102. So as a result, if you're unaware of the latter's implications, you might become frustrated when your long position won't rally, which means that you might be getting in at $100 and you want it to go up to 105, and it's not going past 102. It just keeps bumping its head there. And that's because when you zoom out, you've potentially missed a major level. And that is something that definitely does trip up younger traders, newer traders. Likewise, understanding where weekly and monthly support and resistance lie can help you differentiate shorter term trends from longer term trends. So that's perspective. We currently have a downtrend, which is actually just a correction. So this one is one I would sort of demonstrate to you. So again, and I'll use, again, this is all stuff we all have to learn to deal with. So you have an uptrend on a time frame. So I'm going to go from the upper time frame or the higher time frame down. So in this particular case, you've got a beautiful uptrend, looking great. Next major level's up here. So there's no reason to expect that the trend is going to change. It's going to travel from one major level, which is down here, to the next major level, which is up there. And this is a beautiful uptrend, high lows, high highs. But if you had to go down to the lower time frames, you would see that there is an uptrend on the lower time frame going like this, and then a downtrend over there, which then ultimately goes back into an uptrend. So in other words, it's fractals. Within the bigger time frame, if you zoom in, there are shorter term downtrends. And so from the higher time frame to go down, everything tends to make a lot more sense. But often what could throw you is that if you look at the markets and it's a downtrend, you're getting ready to sell. So you decide to sell over here. You're like, this is a downtrend, I'm going to sell here. And instead what happens is the market starts doing this. And it feels very personal. It feels like the market has just changed direction just as you decided to get in. But actually what happened is you decided to sell over here somewhere. And so again, the market is in an uptrend. Okay, so when we zoom out, that's when we get that perspective, that higher time frame, and we need to be able to do that. That's really important. So now that you want to know context, you want to know where are you within the market's moves. So for day traders, as an example, you would be looking at the 4-hour time frame. You need to know what's going with the 4-hour. Is it going up or down? Even if you're going to be trading only the 5-minute or the 15-minute, you need to know which way they're going. Just trying to determine if I need someone to bring me a glass of water. I think I'm just going to do that. No, it should be fine. That should be okay. So we need to be able to differentiate short-term trends from long-term trends. And going from the higher time frame down for newer traders will actually help you a lot. It's when you kind of look at a 5-minute, you need to get a sense of what's going on. So I'll tell you what, as an actual exercise, let's go to the charts, let's clean this up. Let's go to a 15-minute time frame and let's run through a chart until we find a really nice trend. And then let's get a sense of what's going on. So I'm just going to go through to Aussie dollar. So Aussie dollar is currently got a bit of a downtrend there. Actually, let's stick with that. Let's go with Kiwi dollar. Nowhere. So here, Kiwi dollar is range bound. It's ping-ponging between these levels. So what I'm going to do now is I can zoom out a bit. And actually, when I zoom out a bit, and it might not be that obvious, but I'm going to help make it more obvious, is that actually it's going in a bit of an uptrend. Okay, so it's actually trending higher. We've got a low, higher lows, higher lows, higher lows, and a series of higher lows here. And so, yes, if it breaks out there, this makes a lot of sense. The probabilities are, especially because we've had we've broken above levels over here, very good chance that it's going to continue to the upside. Okay, so but how do we take advantage of this as a trader? Well, first of all, we need to acknowledge that it is currently stuck within a range. So that means that we don't really want to engage in it potentially until after it breaks out above that level. So we keep watching it until it breaks out. If it breaks below this level, which is not impossible, but much less likely. Why less likely? Well, the trend is up. We've broken through resistance previous highs. So in other words, we're now operating at brand new highs from, a week ago. So the market is more bullish. It's investigating higher prices. It's taking a bit of a breather, probably because it had a big move here. So it's taking a bit of a breather. Okay, you'll notice after a big move, the market might take a bit of a breather. Okay. On the 15-minute chart, an asset could be in a short-term uptrend, while on the weekly or monthly charts, it might be in a long-term downtrend. And knowing this in advance can help you optimize your stop loss levels and enhance risk management. So if you kind of know where the key levels are, you know where you want to put your stop loss, for example, or where you need to be taking profit. So again, let me illustrate that by drawing this. So on the higher time frame, much higher time frame, maybe the weekly, for example, the market is trending here and it's got to this point and it started to go down. So it's at the early stages of a bit of a pullback. So what happens is, well, you might be like, okay, there's a major level and maybe there's a major level up here, there's the most recent high. And actually there's maybe a fair possibility that it's going to pull back. Didn't like the way I drew that. I should do it again. So let me do that again, actually. So we have a move and a pullback, a move and a pullback and a move, and it started to pull back there. And so we notice that often actually the market might come close to these previous highs. That often happens. You get a break and a retest and a break and a retest. So we know there is a possibility that the market is going to pull back into this area. And if we're looking at this, for example, as a daily, this might take 1 or 2 or 3 days to come back down. So day traders will be looking for short-term moves just in this area, because as soon as it approaches, as it starts to approach this area, the possibility of it turning around and going up becomes very real. So you have a short window which might last 2 or 3 days where you can look for shorter term opportunities. So you definitely have to mark that level, you definitely have to mark this level, and then you might be looking at a few others. Maybe when it was moving and maybe it did on the 4 hour, it did a bit of this, so you need to mark those levels. So you kind of need to find the market structure on the lower time frame. But you know that the bigger picture says that there's a very good chance that the market is going to go from here down, at least down to here, maybe down to here, but at least down to here, which means you've got this amount to take advantage of much lower time frame selling opportunities as an experienced day trader with a risk management strategy and a trading strategy. Okay. Hopefully that makes sense. So now we're going to talk about placing your first trade. I think before we get to this, let's go and do some real-time analysis, looking at support resistance levels and get a sense of multiple time frame analysis. Let's do it on a real market right now, which is, the timing is perfect. Okay, the timing is perfect because right now the markets have been experiencing a very strong correction. This is the S&P, the global markets. Now they needed to do that. And so for the newer traders, you might be going, well, why do they need to do that? So we're going to do it with the S&P 500. Why are we going to do it with the S&P 500? We're going to do it for the S&P 500 because the S&P 500 has 500 individual constituents inside it. So as a sample size, it's way better than the 30 in the Dow, or the 100 in the NASDAQ. Besides, all of the ones in the Dow and all of the ones in the NASDAQ are also in the S&P 500. So the S&P 500 becomes just one of the best charts to analyze for also the global indices, because companies inside the S&P 500 include McDonald's and Starbucks and Nike and all the companies that you know that are global. So the first thing we want to do is we want to have a look at the daily. Now, most people look at the daily and the problem with just looking at the daily, which is what a lot of professional contributors or social media analysts will do, is it doesn't give you perspective. It doesn't give you perspective. So there's a period over here where the market is incredibly bullish, and then it becomes bearish, right? And now it's kind of bullish, because when you look at this behavior, it's exactly like what we see here. It's bullish within that. So the problem as well is that whenever you have a correction, and this is what the social media people get wrong, you have these corrections. There's one, there's one, there's one, there's one, there's one. And then you have them here as well. There's one, then you have them here, you've got them here, because this one here, and it's not that big. From there to there, it's actually similar to that. It's a little bit bigger than that, a little bit bigger than that, maybe about that size. But the problem is that the media starts saying to you, oh no, no, the world is collapsing, blah, blah, blah. And maybe you hear it, maybe the timing of it overlaps with Iran attacking like Israel. So all of a sudden it's like it's combined and you're convinced that they're correlated, and they're not. They're not. All right, we have them here. Pull back, pull back, pull back. It's profit taking. It's a heartbeat, breathing out, breathing in. The market is just constantly doing it, and it will always do it. It will do it forever and ever. There was a smaller one there. There was a little bit of a one there. There's a bigger one here. But to think that this is the same as this is ludicrous. There's just not enough evidence to support that. And actually, when you look at the collective structure here, it looks way more like this than anything else. And look at the angle of it. It's really nice and bullish. So the first danger is that when we look too closely at things, we don't have perspective and we overreact and we misread the situation. So the very first thing you would want to do is, the first thing is you need to understand that the markets are always going to go up and down, up and down. You're getting an extension and a retracement, an extension and a retracement, an extension and a retracement. And the more bullish the market is, the longer it's gone without that correction, the more likely you are definitely going to have a correction. You cannot have one thing, you have to have both. So you're always going to have these things, always. And this market had been running and running and running and running without a proper correction. It didn't have a decent one. It had a tiny one here, but nothing else. So a big one was overdue. So that comes from experience. I know this, and it comes from experience. So we knew a big correction was overdue. So when it happened, it's good. But we want perspective. So when we only know this much, if this is all we're looking at, if we only look at this, excuse me, if this is all the information we have, we're going to look at this past history here, and we're going to see a big move down. And so we're going to misread it. We're going to go, oh no, this move down is so big compared to that one and that one and that one and that one, the world must be ending. And this is what happens, and the media does it. And why do they do it? So you'll click on the articles, and so they get money for advertising and clickbait. But at the same time, they can always argue and say, well, we are talking about the market correct or having a correction, so it is. So we're not lying, but they also wrap it in very dramatic terms. They don't say this is an overdue correction. We need this. The market's been too bullish. Needs to take a bit of a breather. What they will say is it connected to the war? Is this the beginning of the end of the world? Like, they'll really dramatize it. So you've got to understand they're not motivated to give you, I don't know why, but they're not motivated to give you objective reason stuff. So anyway, we have this correction now, and as you zoom out, you get a bit more perspective. You can see that at other points in the past, we've had bigger corrections, and it's normal. It's normal. So then what else can we do? Well, whenever I start to see a big correction, which I'm usually expecting, or even if I'm not, the first thing I do is go to the higher time frame. Because remember that your move on the higher time frame is going to be a change of trend. So if we have a daily downtrend here and a daily uptrend here, that actually means that the higher time frame, the weekly, is having a retracement. It's not a change of trend, it's a retracement. So what does the weekly look like then? So if we go to the weekly, we have a beautiful uptrend that's having a retracement. So here was a downtrend on the weekly, lower highs, lower lows. Here we have high lows, high highs. We're in an uptrend. And again, I'm showing you this without color. I'm showing it to you without color. I want you to just see the structure of price. We'll bring in color in a moment, because the color is an additional layer of information. And if we go to the monthly, what do we see? Well, from a monthly perspective, when we zoom right out, we have a low and a high and a higher low and potentially a high high. So we're definitely in an uptrend on the monthly. So we're in an uptrend on the monthly, and we're in an uptrend on the weekly. But on the daily, we're having a bit of a downtrend. So the beauty of this technique is that it shows us that within the weekly and monthly, things are not bad at all. We need to stop panicking. In fact, if you follow Fibonacci, for example, Fibonacci retracements, and you measure, say, from this low up to this high, this retracement hasn't even hit a 382. So from this perspective, from the last really big low to this high, we haven't even had a 382 retracement, which is like the bare minimum retracement. That shows you how overdue we were for this pullback and how little this pullback actually is within the bigger picture. And if you really want to be fussy, we can then move it up to here, to this higher low, and it's come back and bounced off the 50, which is normal and very healthy as well. So no matter which way you spin it, the market correction, which the media has been very dramatic about, the correction is very normal and very healthy, and actually to be expected. And we will have them again. If the market continues from here and goes up, we'll have at some point another correction. And what will the media pin it to or attach it to then? It'll just be seasoned investors and traders taking profit, some short sellers coming in, because they're the market participants. They just need to see that it's happening, and then they just jump in. They don't care what it is. And so will it be a war? Could it be something to do with Russia? Could be something. But wars happen, people die, elections happen, all kinds of things. These things, there's almost very little that has not happened on the planet before that isn't just the same thing. So it's usually one of 10 different things that causes that market correction. My point is perspective. Now I'm going to bring in color. Before we move on, let's go through. I've got some templates here. Let's bring in color. So now we have color. You can see how many lots of green candles there are. We pull back. We've got a beautiful bullish candle right now. Now what I'm going to do is go even further, and I'm going to bring in the moving averages. I'm going to get rid of this one indicator. All right. So what I'd like you to observe here, please, ladies and gentlemen, is when we have a very nice when we have a very nice trend anywhere on any market, any currency, you'll notice how often price bounces off these moving averages when it's a beautiful trend. It sort of bounces off the 10 and the 20. So what I've got is a 50, 20, and a 10. It sort of comes back to the 10 and the 20, bounces off that. That's really what it does all the time. Very nice and healthy. And occasionally it'll come down to the 50, occasionally, and then it carries on. So what do we have happening now? We pull back to this, and you can see prices pull back to the 10 and 20. It's been running for a very long time, pull back and produced a very nice bullish candle. And again, you can see those bullish candles. There's a bullish candle, there's your bullish candle, there's your bullish candle, bullish candle, bullish candle. These are actually bullish shaped candles. That's okay. There's a bullish candle, there's a bullish candle. Here are my bullish candles. There's always these bullish candles. It comes back, then the buyers come back into the market, and then they push it up and it does it again. And this is where we are right now. Okay. So 2 more things, and then we can move on from this. So 2 more things. First of all, why am I so confident that we're in a bull market, aside from experience and really good training, is that bull markets tend to last anywhere from 5 to 15 years. They have last a very long time. Bear markets last anywhere from 2 to 3 years. They don't last very long. The exception to that might be the 1929 stock crash, but we didn't have the 1929 stock crash. We had COVID here, and we had a bear market last year. So within just 3 or 4 years, we've had 2 very big market corrections. So the market has been trending higher. There was a little bit of a bear market here. We had a bigger bear market there. And actually, it's been trending up a little bit higher. So because we've been sitting with COVID and with all kinds of other stuff, we've been sitting with very bad news, and the media makes more money from talking about bad stuff. And then basically, when you're sitting in it all the time, you just think, well, especially if you must be in your 20s, you must like, well, life has never been good. But actually, there are large periods of time where life is not terrible and it actually is relatively good. And the thing is that just the last 5 or 6 years, it really has been a bit of a struggle. So my point is this, is that we've had our big market corrections. What we are now free to do is to have a really nice bull market. So that's the fundamental idea behind it. But the technical clue is that if you look at the weekly and you look at the 50-period moving average, very simple. It's a very simple analysis. If price is above the 50-period moving average, you are in a bull market. If price is below the 50-period moving average, like it is here, and like it is here, you're having either a big market correction or you're having a bear market. Okay, so that would be BU and a bear market. I don't even want to write up the full words because I'll just do it so badly. So that's your bear market. We're now sitting above the 50-period moving average, and we're in a bull market. And again, they last anywhere from 5 to 15 years. We've had a bear market now. We are free in a way to trend higher for quite a while. So your trending up is often much longer than your bear markets. And last thing, so I said there were going to be 2 more things I was going to say. So the very last thing is that the quality of the trend gives you an indication. It's like a heartbeat. It gives you an indication of how healthy the market is. And when you look at the market here, it is very, very healthy. In fact, it didn't even come back to touch the moving averages enough over here, which is why the correction here is bigger. So if the moving averages are there and you get a move like this, you won't have a very big correction. But if the market just goes like this, it goes like this, eventually when you do have that correction, it's going to be a bigger correction. So it's always kind of swings and roundabouts. When you look here, look how stable and steady this was. And that was your big sort of correction. Yeah, and we've had a really big move here. This is our correction. And we've got this very nice green candle. So is this 100% definitely the turnaround point? I would say that there is a 70% chance that the market is going to recover from here and go higher. But that's because the previous move is so nice and healthy, and because we've had lots of corrections. We don't really need to have a correction anytime soon. Forget what the media is saying. Could it come back further? Yes, it could. And what I would do is I would use the Fibonacci for that. So for that, I would say, could it come back to here? Could it come back to these old highs over here? Yes, it could. Could it come back to here? Yes, it could. If, in other words, if it wasn't finished yet. Or could it come back to here? Yeah, it could. Any of those. But remember, it could come all the way down, all the way down, all the way down to here and still be a healthy pullback, because the 618 is a standard pullback. So what I'm trying to tell you is that I think that that's unlikely. I think the furthest it could pull back now would be somewhere in this area, possibly even down here. So how would we know this? Well, if next week or next month or next week we have a really bearish week, then we're probably still going to continue down to the 382, and then we're probably 382 or the 50 fib, somewhere in this area, and then we're going to go off. And again, that's very healthy. The media will make it out as like, oh no, it tried to resume and it failed, and now it's even worse, and now it's definitely doom and gloom. And it's not. Within that, and this is why we're talking about multiple time frame analysis. This just keeps you calm, because you have from a geography perspective where a healthy pullback would be. All right, I'm going to leave you with that. Let's move on and have a look at the kind of taking trades scenario. So there's a very cool, excuse me, there is a very cool free tool available called position size calculator. Okay, so I'm going to show you this now. It's a little bit intimidating at first because it's got a lot of different settings that you can play with. Don't worry about that, because you don't use all the settings. You only use about 5 or 6 settings, but they put everything in there for everyone. The point of this is that when you're on the platform, you can use this tool to potentially help you take trades or to calculate how to do that. So for example, I might have a chart. Let's just see if I've got it. I could put it on the chart here, just take it as is. For example, let's just do that, and it will load up here. And this allows me to potentially calculate my entry, my stop loss, and my risk. I just want to show you this because it's free. It's available, and I'll give you the link to it now. I'll just take it, put it in here. You can download it. It's all detailed. I think there's even YouTube videos on how to use it. And honestly, I don't think it's more complicated than learning how to use the platform. It's just that it has 100 settings. You're like, oh no, what am I going to do? You just need to play with it. So let me send that out to all of you. Well, let's see if I can, or at least give you the thing here. So basically, it's earnforex.com, or you can just Google position sizer. If I go all the way to the top, you can see it's just called the position sizer EA if you're using the platform. Okay, and it's Earn Forex. So there, you want to make sure that you arrive at that. It's just a free tool. It's available to anyone. Okay. So this allows you to kind of place your entries. Are you using an instant or pending order? And if it's pending, you can then place your order where you want it. You can move your stop loss where you want it. You sometimes just have to play with it a bit. You can then have your target where you can move where you think your target should be. Sometimes you can put the number in. You can switch this to points, or you can put it value in. So you can use the value here, or you can just say 100 points or 50 pips. You can have all of that. You can have defaults take profits. So mine is set to 1.5 to 1. So if I just push that, it will automatically adjust it. And then I can say my risk. So my risk would be, I can even have presets where I save it. So my risk is 0.5%, for example. And then it'll calculate all of that. It shows me if I need it, it'll show me what my margin is, my swaps, all the different things. Give me that information if I want it, but otherwise I can use it. And then, for example, I can use the script and place it. So there's a whole lot of information that you can get from that. We'll show you how to do it. The reason this works very well is because it allows you to place trades and place orders relatively quickly and safely, because your risk is calculated correctly. It's kind of easier to sort of, for newer traders, it's much easier to kind of calculate your position size on currencies. So for example, if we go through, let's go through to Aussie dollar as an example. We go down to the 1 hour time frame. So we have a bit of an uptrend here. So what would I be looking for? What's the general trend? Well, the higher time frame so far seems to be an uptrend, but it seems like it's retracing back down to the moving averages. So possibly this area here, possibly, is where it's going to come back to. Does that make sense? So we have a downtrend here. We've broken through the trend. Now we're in a bit of an uptrend. I can see that there is some form of support and resistance in this area. So I suspect this will come down to this area, the moving averages will come up here, and it will probably find support and then carry on if it's going to do that. So I'd look for a green candle over here. This is the TWP way. Look for a nice little buyer's candle in that area. So I'm a little bit cautious of setting up an order right now, but that's what I would do. So then I would kind of go through to pending orders, you know, potentially have a buy order there. Where's my stop loss? I need to make sure all that stuff is in place. So my stop loss ideally would be below that candle, or in this case, below this swing low. If I'm confident the market is going to turn around, then I could do that as an order. And where do I want to take profit? Probably up here at about the top. Okay, so just up, need to unlock that. That's locked, so just take it up there. And so I could use this to place an order. Okay, and then I could say, well, I'm going to risk half a pip, or I could put in, if it's going to be 0.1 or whatever, for example, I could have that calculate my risk. And so that I can go by lot size, I can do different things, or risk, reward, and take profit. It's a nice little tool that is worth playing with to have it help you just interactively place what you want to do. Alternatively, if we're looking for something, so I want to go down and find something that has a potential setup that's occurring now. Let's look at dollar yen. So for example, dollar yen is breaking up through this. My only concern is there's some bearish divergence. I'm a little bit concerned that it's ultimately going to have a bit of a correction, but I could broad-based, I could kind of do something here. So we've had a pullback into the moving averages. Look at the 50, the 20, and the 10. There's a nice bullish candle. So one way of getting in would have been potentially an entry above the high, sort of above there, stop loss below the low, and I could take a trade from there. So that's not a bad idea. Let's go down to the 4 hour, see what's happening there. So this is a little bit more aggressive, but I could say, okay, I'm going to get in where the market is now, and I'm going to put my stop loss over here below this low. This is actually below the daily low, but I could move my stop loss and just kind of a slightly tighter stop loss. I'm a little bit concerned about that divergence, might have a bit of a correction, and I could enter live. So if I enter live, I've got to know what the difference is for my, let's just go there and nope. And you know, I've got to have my entry, my stop loss, and I've got to have a take profit. Take profit is the biggest mistake a lot of beginners make. They don't really do that. So let's just say, for example, my entry is 154.92, 154.92. My stop loss is going to be 154.34. I'm just going to keep the numbers very simple, .34. So the difference between those two, or for example, if I make it 32, is conveniently is going to be 60 pips. So my position size, we're going to talk about what's my position size, but my entry to stop loss is 60 pips. Okay, so that's kind of my trade size. My trade size is 60 pips. But what's my budget? What is my budget per trade? So you've got to be able to take your first trade. What's my budget per trade? Let's just say that hypothetically speaking, I have a $1,000 account, which means that I can take 1% trade. So I have a $10 trade budget. That's all I'm allowed. So that means that I have $10 that I'm going to have to, so your position size means $10 that you have to spread over those 60 pips. $10 has to be divided over those 60 pips. Okay, so we go do that. My $10 budget has to be divided over 60 pips. That gives me approximately, I'm going to round down, 16 cents. 16 cents, okay, per trade, per pip. Okay, so in other words, the distance from entry to my stop loss, I have $10. So if price does go and stop me out, I lose $10. But it's a 60 pip distance. So it turns out my position size, as they call it, your position size is 16 cents a pip, which adds up to that'll add up to my $10 in the end. So I'm going to go ahead, I want to place a trade. I'm going to go to my new order. First thing I want to do, make sure I'm looking at the correct instrument. It's got to be the same thing that I'm trading here. My volume is going to be that position size. So my volume is going to be 0.16. That's it. Sorry, I beg your pardon. In this case, that's actually $1.60. I beg your pardon. So actually, I'm just going to round it in and put it in at either 0.02, which is 20 cents, or 0.01. Those are my only options at this time. As the markets become more liquid and technology gets better, we're going to get actually a third decimal place. We'll get more, so it works really well. my stop loss and my entries. So am I gonna enter live? Yes, I'm gonna enter live. So my stop loss is gonna go in at 154.34. My take profit should ideally be 180 pips away. It should be 3 times that, which means that if we go back to this, it would be 180 plus 154.92. Okay, so 92, we'd have to go ahead and do that. So let's just go and use the calculator to do that. So what is 154.92 plus, is it 180 like that? What would that do? So that comes to 156.72. So I've added the 180. 156.72. 156.72. We'll see the line anyway afterwards. There we go. And I like to comment it. So this will be USD, and I'll put the time frame daily. Okay, so I'll be doing that. Market execution, buy by market. So I've just put a little comment in there so I can track it. And not enough money because potentially the trade is too small. Let me just have a look and see what the budget is. Oh, this is a live account. I beg your pardon, so there's no money in the account. But that is how I would go about trading it. Okay, so that's the only difference. So that it's a live account, so there's no money in that. But if I did do a demo account or a live account with a grand in it, that would be how I would go about doing it. Okay, and so the point is, so what I want to do is just very quickly wrap up here, is talk about how the only way you can gain experience as a trader, the only way you can really get it is to take lots of trades. But not taking lots of, the worst thing to do is to take lots of trades with different strategies. What you want to do is find 1 or 2 strategies, master those, take lots of trades using those strategies. Because usually once you take 50, 60 of trades using a strategy, if it's a decent one, you'll start making money. Because there's lots of different ways of making money. Some people get so caught up in the different strategies, they never get to the place where they do one strategy long enough to master it to make money. But that's what the demo account is for. The demo account is there for you to get used to navigating the platform, calculating your position size, your pip amount, and pulling the trigger, finding the setups, have a strategy that does it. Let me give you an example, and then we wrap up. This is a head and shoulders pattern. It's a change of trend from an uptrend to a downtrend. There's an inverse head and shoulders pattern, which is a change from a downtrend to an uptrend. This pattern, if you trade it, okay, so if there's a break of the neckline, if you get in there and your stop loss is there, okay, and this is the distance from the top of the head to the neckline, this pattern, if you trade it, it has an 83% success rate, meaning on average 83 out of 100 patterns that you see like this will hit their target. You'll make 1-to-1 on that. That's like a straightforward strategy with 83% success rate. So you don't even have to think about it. You just have to learn how to identify head and shoulders patterns on any time frame and make sure that your entry is calculated correctly, your stop loss is in the right place, and you take profit. And if you do all those things correctly, you should make money 80 times out of 100 or 80% of the time. And that's a basic, it's so basic and so not sexy that most people go, I'm going to go look for something more complicated and more, convoluted because that's too easy. And that happens. People do that. And then they can't understand why down the line, the most experienced traders are just doing the really simple stuff, because we all kind of go through that route. I'm just trying to spare you that pain. So ladies and gentlemen, I want to say thank you very, very much. It's always a pleasure. I hope that you found this instructive and useful. I didn't see any questions, but I thought if you did have any questions, you could. Actually, just before we go, I'll very quickly show you kind of if you're curious. I've had a particularly good month. Where's this other one here? So far, this is one of my live accounts. So you can sort of see the live account here. I'm up 6.8 for the month so far. Let's just see if it's changed. Has it gone up a little bit? Okay, no, it's still 6.8. So it's been a decent year as well. So this is also trend trading, looking at different markets, currency markets, commodity markets, indices, not super complicated, looking for strong trends and trading those trends, taking profit at 3-to-1, 2-to-1, or 1-to-1. Okay, nothing super complicated, not that stressful, not always that stressful, but like keeping things simple but focused is probably the way to go. So again, thank you very much. I think what we covered today is one of the most important concepts of understanding perspective. Gives you a sense of where the markets are in relation so that you're trading in line with the general market momentum. And also understanding the difference between short-term moves within a window versus, you know, what the bigger picture is. And so again, I hope you enjoyed this. If you have any questions about your account or to do with the platform, please don't hesitate to get in touch with the lovely folks at Vantage Markets. Here are the contact details, so if you do need to get hold of them, you can see.